Did you know that in 2020 alone, the United States printed a whopping 35% of all the dollars it has printed in its entire history? Yes, that's right. And this unusual move has raised concerns about its impact on the world economy. So guys, join us as we unveil the hidden truths behind this massive money printing and its potential effects on the global financial landscape. With that said, let's get right into it. We all know that printing money can be really bad for an economy. Every time a country tried doing that, it resulted in disastrous consequences. Let me give you a couple of examples. In the 1920s, the Weimar government in Germany printed over 500 billion paper marks, and within 3 years, the inflation rate skyrocketed. It got so bad that at its worst, it took 4.2 trillion paper marks just to buy one US dollar. Similarly, Venezuela printed 4 trillion bolivars by 2020, and their inflation rate reached over 4,200%. Now, in 2020, the United States printed a massive $3 trillion in just 3.5 months. It's kind of surprising though, because unlike other cases of currency printing, the US didn't experience hyperinflation. When it comes to US inflation, it went up to about 9%. Surprisingly, this had a reverse effect. Instead of inflation only increasing within the US, inflation increased in countries around the world. So even though the US printed $3 trillion, inflation increased in other countries as well. Not just in the US, that's not entirely due to the money printing in the US. The pandemic, the Russia-Ukraine war, and supply chain issues had a massive impact as well. To understand the US money printing power, let's talk about something called quantitative easing in a simple way. In the US, the Federal Reserve lends money to banks like Bank of America. Then, Bank of America lends this money to people like you and me as loans. To make a profit, Bank of America charges a higher interest rate than what it pays to the Federal Reserve. Imagine Bank of America lends money to a person, Mr. Smith, for a home loan at a certain interest rate. If the Federal Reserve increases its interest rate, Bank of America also has to increase the interest rate on Mr. Smith's loan to maintain its profit. Let's talk about Mr. Smith's situation. When the interest rate on his loan goes up, the amount of money he has to pay each month also increases. As a result, he has less money to spend on other things like cars and vacations. Many others in similar situations would also spend less on such items. This leads to less consumer spending. This becomes a problem for businesses. The costs of making their products have also gone up. For example, car manufacturers like Toyota may have to spend more on things like parts, gas, and shipping. So they have to raise their prices as well to be able to make some profit. This creates a situation where consumers can't afford higher prices and businesses are selling less because the consumer is no longer able to afford certain products and luxuries. As a result, the economy experiences a difficult situation where people are not buying as much and businesses are struggling to sell their products at a price that attracts enough customers. This could lead to a recession. It's like an economic nightmare because money is not flowing into the market and it affects businesses, consumers, and therefore the overall economy. To address this problem, the Federal Reserve can use a method called quantitative easing. This means they lower interest rates and inject more money into the economy to get it working again. Now let's talk about how US money printing and quantitative easing can affect the global economy. To explain this, let's use another analogy. Keep in mind this is just a made-up example and not a representation of the current economic situation. Let's say Mr. Smith owns an oil company in Germany. Oil is priced in US dollars, and let's say a barrel of oil is $100. The US decided to print more money and lower interest rates. Because the US printed more dollars, $1 is now worth less because there are more dollars in circulation. Before the US started to print more money, $1 was equal to €1. Because the US printed more money and the value of $1 decreased, €1 is equal to $1.50. Mr. Smith is pricing his barrels of oil in US dollars. However, his bank account is in euros because he's living in Germany. Before the money printing, Mr. Smith received €100 for 1 barrel of oil because $1 was equal to €1. However, because of the money printing, €1 is now the same as $1.50. For the exact same barrel, Mr. Smith is now receiving about €67. Because 100 divided by 1.5 is approximately 67. Now he has to increase the price of the oil barrels to $150 to receive the same amount before the money printing. When more people from other countries buy U.S. products due to the weaker dollar, it creates a higher demand for those goods in other countries. This increased demand can lead to inflation in those places. Inflation means that the prices of goods and services go up over time, and people might end up paying more for the things they need. Let's take the example of Toyota cars. As more cars are sold to the US, Toyota might raise the price of the same car in Germany to match the dollar price, which is now 55,000 euros. It means that if Germans want to buy a car, they have to pay more euros for it. The higher demand for US products in the US also leads to higher prices for those goods within the country. And when prices go up for various goods and services across the market, inflation happens not just in the US, but also in other countries. So when the US prints more money, it has significant effects on the global economy and can contribute to inflation not only in the US but also in other nations. In a nutshell, the weakening of the US dollar makes American products cheaper abroad, increasing their demand in other countries. And this can lead to inflation in those countries as well as in the US. When the US prints more money, it can lead to currency depreciation and inflation. Currency depreciation means the value of the US dollar goes down compared to other currencies, like the euro. Imagine car companies like Volkswagen, BMW, and Mercedes want to sell their cars in the US. To do that, they need to buy euros, because their cars are made in Europe. When there's high demand for euros, the price of the euro goes up compared to the dollar. This means that car companies have to pay more in dollars to buy euros. Now when the US prints more money, there's more supply of dollars in the market, and this can weaken the value of the dollar against other currencies. So when car companies buy euros, they get fewer euros for the same amount of dollars they used to pay before. As a result, the cost of importing cars into the US goes up, and that can lead to inflation. Inflation means the prices of goods and services increase, and people might need to pay more for things like cars, clothes, and other imported items. At the same time, American products become cheaper for people in other countries because their currencies become stronger against the dollar. So European companies that export goods to the US might have to charge more in dollars to cover their costs, and that can make their products more expensive for American consumers. In the end, this whole situation creates a complex web of changes in prices and costs for different companies, and it can impact both the US economy and economies around the world. It's like a big game where currencies and prices move in response to each other, and it can have significant effects on trade and the overall economy. As a result, the export cost of European goods has increased due to currency appreciation, making their products less competitive in international markets. To make their exports more competitive, Germany, for example, would have to print more money to depreciate its currency, leading to inflation in Germany. These are the two ways in which quantitative easing in the US causes inflation in other countries. The moral of the story is that the US can continue printing money to a large extent and still avoid hyperinflation as long as the US dollar remains the global reserve currency. Alright guys, thanks for watching. What do you think is the way out for other countries? And what do you think the US should do to cushion the effect of their money printing strategy on other countries? We'll love to hear your thoughts in the comments below. Also, don't forget to give this video a thumbs up and hit the subscribe button for more.